Hey everybody, this is Ryan Mallory, and we're going to be talking about whether you should be buying some silver right now. This thing has gone through the roof this week. It's crazy. Gold is up too, but silver is the play right now. Now, it went up 9% on Wednesday. It went up another 6% on Tuesday. It was up on Monday. It's on a 4-day winning streak. It's up 8 out of the last 9 days. The volume is incredible because the retailers are starting to pile into it. You have a lot of factors in play here. You have a dollar that's rapidly being devalued. You have the House, you have the Senate, you have the president. They're all wanting to do stimulus. You have the Federal Reserve and begging them to do more stimulus. The Federal Reserve is meeting next week to consider more stimulus. There's a lot of stimulus here, guys. They're pumping money. They're not letting their foot off of the gas pedal when it comes to the money printer here. And with $27 trillion now of national debt and more to come, we're probably gonna see $30 trillion before the end of this year or the year to come. You have the prospect for rapid inflation. That's why gold's going up. That's why silver's going up. And this week, the silver market has cast its vote of absolute no confidence in the Federal Reserve with this kind of price action that we're seeing right now. Instead of Tesla, instead of Square, instead of Amazon, instead of the FANG stocks, we're talking about silver, we're talking about gold. And when you start seeing the Robinhood traders pile in, and when you start seeing the street chasing this particular trade, that's when you're gonna start seeing some real fireworks in this market. Now, just to recap, I got out of my trade today. That doesn't mean I'm not gonna get back into it. In fact, I wanna get back into it, but it needs to be at the right price. On July 7th, I got in at 1704. You have an ascending triangle pattern. It broke out, and that's where I got long at. Did I know that it was gonna go all the way up to 2144? Yeah. No. Especially within a month? Absolutely not. Silver and gold, it's been almost a decade since we've seen these kinds of moves coming out of these particular commodities. In fact, silver, since the March lows, has almost doubled in price. So I got long on July 7th, put my stop loss right below the June 18th lows at about 1610. And then on July 9th, I took about 1/3 of my position off and made about 3.8%. It climbed higher on Monday of this past week here. I went ahead and took another 1/3 of my position off. That was for about 8%. And then yesterday, when we saw that massive move, it climbs over 6%. I was up 16.3% on the trade. I had moved my stop loss up multiple times. I go ahead and get out at the close for about a 16.3% profit. Now, what was crazy is what it did today. Of course, I'd still like to be into it, right? I don't know if that was completely expected for a 1-day move. I thought, okay, we're probably gapping a little bit too much here. We're probably getting a little bit exhausted. Volume's pouring in. We're going to probably pull back at some time in the very near future. I still think we probably will. There's a lot of hype coming in. People are going to start becoming short-term bag holders. They'll panic. It'll cause a little bit of a pullback, and then that's the time you want to get into the stock. Ultimately, I think it wants to go higher. I wish I was still in it when it made this move on Wednesday. That would have been great. However, I'm not worried about it. I made 16%. I followed my trading plan. I had a price target of 20. It got to 1981 where I sold it on Wednesday. I'm okay with that. I followed my trading plan. I managed the risk. It was an excellent trade. Now, when you get out of a trade, stocks go up and stocks go down. I can't do anything about what it wants to do after I get out of the trade, nor does the market care what I think it should do when I get out of a trade. What matters is that I control myself, control the emotions, and I manage the risk. Now, check out this key trend line coming off of the March 18th lows. It rides this thing perfectly, and then it goes parabolic the last 2 days. Ultimately, what I want is for the gaps from the last 2 days to get filled, pull back to this rising trend line, and give me a bounce. That's the ideal situation there. That would be somewhere between 1850 and 1950 per share on the silver ETF SLV. If it can do that, I'm in business. Now, you also have these triangle patterns that have emerged that have led to some excellent breakouts during this incredible run. Maybe we can get another triangle pattern just like what we saw in April and just like what we saw again in June. The June one is the one that I played and made a good profit off of when it broke out on July 7th. Ideally, I'd like for us to get another one of those because if it can pull back or if it can just consolidate somewhere between the 19 and 21 area and give us another triangle, that's where I'd want to break out to the long side again. But these gaps are really big at this point. Massive, they're glaring. I think it could easily lead to a shakeout, especially if you've got a lot of retailers in at this point, which I think you do. I think you see a good shakeout that fills these gaps and pulls it back down to the trend line, giving us another chance to get back long on the trade once again. Because ultimately, I do think silver continues to march higher. I think gold continues to march higher. However, regardless if you think it's going higher or lower, you have to manage risk. You have to be a manager of risk to be successful in the stock market. That's why I'm not just jumping right back in at 2144. Even if it decides to go to 30, I don't think that it's a good idea to go chasing stocks without a good risk plan in place. And with these two massive gaps, I don't think that there's a good way to manage risk at this very moment. So I need to wait for it to come back, or I need to wait for it to consolidate. If it consolidates at these highs, then maybe we can reassess, okay, if it's like a triangle pattern or a bull flag pattern, it'll probably be a good opportunity to get long. I need to let that pattern develop first and not just jump in because I fear I'm missing out on a bigger move to come. Also, what you want to watch is this 20-day moving average. I think the 20-day moving average has been a great place on a lot of stocks, and also it can be on this ETF as it is consolidated around this 20-day moving average, which is the green line on this chart here. If it can pull back to the 20-day moving average, or it can consolidate around it, that may be another area that you want to get long at and play the bounce off of that moving average. It's not a perfect bounce. You can see that it goes above and below it quite a bit. In that area, there seems to be some support there over the past 3 to 4 months. Now, if you're still in the trade, watch the 10-day moving average. That's the orange line here. So far, it's not breaking it on this run, but it's going to be a good trailing stop loss for you if you're trying to find a place to get out if it starts to pull back. If you want to be even more aggressive with the stop loss, use the 5-day moving average. But we've seen a lot of stocks, we've seen a lot of ETFs, people get really hyped up on these things, okay? They start seeing this big move and they think it's never going down again. Just like Tesla, people were talking about it being at $3,500 by the end of this month. Maybe that still happens. Not likely to, though. People talk about Amazon going to 5,000. People talk about the S&P 500 being 4,000 by the end of August. All these scenarios, while not impossible to happen, you're looking at a 1 to 2% probability, if not less. So don't play those real small probabilities. Know that the stocks can pull back, will pull back, and that's where you want to look at to get long on those pullbacks. Let's go back to 2009, looking at the weekly chart, and you'll see 2009 to 2011, there was a huge move that unfolded. Now in 2009, we're coming out of the Great Recession. It starts to go from about $10 a share all the way up to about 15. From there, it consolidated, and then it had this explosive growth moment over a much longer period of time. Not like what we're seeing now, where we're talking about days instead of weeks. We're talking about a sustained major rally over many weeks. And then we got a bull flag like what I was talking about earlier. You see this bull flag here? If you can get something like this where we're currently at, consolidate for 3 to 4 weeks, let silver kind of drift out of the minds and thoughts of traders and then explode higher again, that's where you want to get on this breakout, because I think there's a good chance you could see a very similar move to what we saw in early 2011, where it went from 25 to as high as $48 a share. That's what you're looking for. You're looking to get in on that second move right now. I don't think this first move is just going to go straight to the moon here. There's going to be a consolidation at some point. That's what you're looking for. Now, again, the reason why I say don't overhype yourself on this thing, there's a lot of potential here, but don't overhype yourself where you start chasing, because going back to 2016, the people who started chasing when this thing made a move from below 14 all the way up to $19, look what happened. It fooled them. It went all the way back down to below $15. So you don't want to be a bag holder in this situation. It made a drastic move right when people started to really pile into the ETF. It hit the 200-week moving average and it went straight back down. Now you look at the weekly chart in silver right now. This thing is parabolic, guys, especially this week's move. That's scary. This is not a time to be jumping in. It's gone up 6 weeks in a row, 10 out of the last 11. Be careful here. Let's get some of that bull flag pattern action here where you can maybe get 3 to 4 weeks of consolidation. On the daily, I would love for it to be more like a triangle pattern, like what I played in July, and then what we saw, and then again what we saw in April. Those two triangle patterns provided some really good risk reward scenarios to trade off of. Now maybe you're one of those that say, hey Ryan, I'm not really into silver ETFs, man, I don't want to buy that, that's not enough action. It should be enough action. 9% is a ton of action. But if you're not into the actual commodities themselves and want to get into more of like the miners, there's 3 of them to play here. The first is Hecla Mining. Again, you have a trend line off of the March lows. It's gone parabolic at this point. You can't get into it at this level. The move was around $3.75, and I don't even like these stocks that are below $10 or $5 especially. But that was the point to get in at, okay? So you need to wait. If you're going to get into it, wait for a notable pullback. On HL, because of the risk, I wouldn't get into it unless I have a chance at 375 again. You may not get that, but considering the amount of risk that are in these kind of low dollar stocks, I got to wait for a big pullback on this one. Now, my favorite is probably going to be Pan American Silver, PAAS. Nice trend line here off of the March lows. It's more of a moderated version of the silver ETF. I like this one. Now, if you can get a pullback to this rising trend line to around 33, 33.50, that's where I'd want to get long at on this one. I put my stop loss below the rising trend line and also below the July 8th through July 14th consolidation pattern there, and that would be about 30.85. That gives me a good risk reward situation there where I can make about 3 or 4 to 1 for the amount that I'm risking on the trade. Finally, there's CDE, another low dollar stock. I'm not going to try to attempt the name. I don't know how to say it, so I'm not going to try to embarrass myself here on YouTube. But you got an inverse head and shoulders pattern here. It's already broken through the neckline. It's trying to challenge the highs from December 2019. This one needs to pull back too. So you got the rising trend line off of the March lows. You can play that, or you can play a retest of the neckline. Oftentimes these inverse head and shoulders patterns, after they do the initial breakout, they do come back down and retest that neckline and then try to bounce again. So that's probably where I would try. If I have to choose my favorite miners right now, PAAS, then it's CDE, and then finally HL. In the end, it's just like every other hyped stock that we see or overhyped ETF. There's money to be made, but you can't wait until it becomes super obvious, because when it becomes super obvious, that's when it becomes its most dangerous. When you start chasing Tesla at $1,700, or when you start chasing Amazon at $3,300, that's when it becomes a really dangerous play. You have to make sure that the hype isn't controlling your trading strategy, that your voice of reasoning is. And speaking of being the voice of reasoning, why have you not subscribed to this channel yet if you're watching this video? Subscribe down below. You'll get notified when I post these videos. I appreciate you watching these videos every time I post them. Tell me in the comments below, what is your play on silver? Are you leaning more towards gold, or are you going to stick with silver right now? And if so, what's your timeline? Are you staying in the trade for right now? How high do you think it'll go? And what's your strategy if it starts to turn south again? Thank you. God bless.